Hello everyone, my name is Shauna Thompson, and welcome to this video on credit and why it matters. Credit plays a large role in our lives but can be confusing. This video is intended to clarify some of the confusing parts and assist you in developing a strategy to improve your credit. Let's begin with the definition of credit. Credit is an arrangement that gives consumers a way to buy goods and services now, but pay for them later. Simply put, using credit is a way to borrow money. It lets you buy items today and pay for them later, but it usually costs more than paying with cash because whether you take out a loan or use a credit card to make purchases, you will pay a finance charge, otherwise known as interest. Interest is another term that can be confusing. Interest is a fee paid regularly at a particular rate for the use of money lent, or delaying the repayment of debt. Using credit to borrow money is usually necessary at different times in people's lives. For instance, most people need to borrow money to buy a house because they do not have hundreds of thousands of dollars saved up. But it is important to make sure you do not use more credit than you can afford to pay back. To keep yourself financially healthy, when you go to borrow money, keep these 3 tips in mind. It is up to each person to make sure that they do not use more credit than they can afford to pay back. Number 1, if possible, pay more than the minimum amount due each month. This helps you not pay more than you took out originally. Number 2, if you can increase the monthly payment amount, you will pay off the loan in less time with less interest paid overall. And number 3, if it's possible to pay off the entire credit card debt within the month you made the purchase, you could save yourself from accruing any interest at all. Most cards have a 30-day grace period in which you can pay off the purchase without accruing any interest. Now that we've talked about ways to use credit, let's take a closer look at why credit matters. When you borrow money, many of the places you borrow from will report your repayment activity to the 3 major credit bureaus. The bureaus then collect all of the information reported about you and put it into one document known as your credit report. Whether or not you make your payments on time will play a big role in whether your credit report is helpful or harmful to you. Many businesses are looking at credit reports. The information shared with the 3 bureaus is used to create a credit score. Credit scores can determine whether you are approved for loans or not, and will also determine how much money you will pay for the things that you are seeking. Here are some ways that credit reports can affect your life. First, employment. In some states, it's legal for employers to pull credit and make hiring decisions in part based on what is seen on your credit report and/or your score. Second, housing. Landlords and mortgage lenders review credit reports and make housing decisions for both rental and home purchases. Third, transportation. This can be a double whammy of sorts because you might need credit to get a car loan to purchase a vehicle, but your car insurance rates are based heavily on your credit score as well. Lastly, cell phone. There are many ways to get a cell phone nowadays. Some of the methods do not require a credit check. However, some plans still require a credit check and can determine whether you have to pay a deposit, and if so, how much. When we look at this list of items, these aren't things of luxury, but basic needs to live. Looking at and working on your credit can help you save money not only in your everyday life with your everyday living expenses, but long-term as well. You may wonder whether doing the work to improve your credit is really worth it in the long run. How much money can good credit potentially save you? Here are a couple of examples that show how you can save money in both the long and short term by working on your credit. First example, car insurance. Your car insurance rates are based on 3 things: your credit score, your driving record, and where you live. Let's take a look at an example so you can see how these things work together. Here's a table that shows car insurance payments based upon driving record and credit score. When we look at just credit score and driving record, we can see that credit is more important than any other single factor when determining the amount of money you will pay for your car insurance. Let's take a look at another example. Qualifying for loans. In this case, imagine you are applying for a $20,000 car loan. This table shows how much money you can save by having a lower interest rate. In this example, there are 8 people who each qualified for the same $20,000 loan. If you qualify for a 10% interest rate, you will have a monthly payment of $645.34 and will pay $3,232.24 in interest over the life of the loan. If you qualify for a 2% interest rate, you will have a monthly payment of $572.85 and will only pay $622.60 over the life of the loan in interest. Clearly, qualifying for a lower interest rate can save you a lot of cash in the short term and the long term as well. Today we've covered why credit is important and some ways that you can use credit as a tool to improve your financial well-being. Knowing why credit is important can positively impact your decisions about using credit.